Two buyers walk into the same lender's office on the same July morning, both approved for the same $440,000 house. Both put 20% down at the closing table, borrowing the exact same amount from the same lender. Then one buyer signs for a 15-year loan, and the other signs for a 30-year loan instead. Every video comparing these two loans treats it like a coin flip between a smaller payment and a faster payoff. That framing skips the part that actually decides who comes out ahead over the next 12 years. This video runs the real July 2026 rates, the real monthly numbers, and what each buyer actually has to show for it later. So which buyer is really winning, the one paying less right now, or the one who finishes owning the house outright? Neither buyer knows the answer yet, so let's lock in the exact same starting conditions before their paths split. The National Association of Realtors puts the median U.S. home price at $440,600 this June. That same down payment comes to about $88,000 for each of them at closing. That leaves both buyers financing the exact same $352,000 from the same lender. Same income, same credit profile, same closing date. The only real difference left is the box they check for loan term. It looks like a minor checkbox buried deep in a stack of closing paperwork most buyers barely skim. That single checkbox is actually one of the largest financial decisions either of these buyers will make this decade. Here's where the two paths actually start to diverge, starting with the number printed at the very top of that paperwork. That number at the top is the rate itself, and this week's real rate comes straight from Freddie Mac's own survey. Freddie Mac's primary mortgage market survey put the 30-year fixed rate at 6.55% this week. That's up from 6.49% just 7 days earlier as rate hike odds tick higher. The 15-year fixed rate landed lower again that same week at 5.93%. On that loan, the 30-year payment works out to about $2,237 a month. The 15-year payment on that same loan comes out to roughly $2,957 a month. That's a gap of about $720 every single month just for picking the shorter term. $720 is a real grocery bill, a real car payment, a real slice of somebody's monthly budget. As most videos covering this exact comparison stop right there and call it a simple, obvious monthly trade-off. They compare the two payments, pick whichever side sounds better, and move straight on to the next video. That comparison isn't wrong, exactly. It's just incomplete, because the payment is only one piece of the real cost. The real story is buried further down the loan in a number most buyers never actually calculate for themselves. That buried number is total interest, the actual price of borrowing the money paid out over the full life of the loan. On the 30-year loan, total interest over the full term adds up to about $453,000. On the 15-year loan, total interest over its shorter full term comes to roughly $180,000. That's a difference of about $273,000 in interest, more than half the original loan amount. In the earliest years of a 30-year loan, almost every dollar of that payment goes toward interest, not principal. The 15-year loan flips that ratio much faster, sending real money toward ownership from nearly the first payment. The 30-year buyer isn't just paying less each month, they're financing the same house for twice as long. Every extra year of interest quietly builds the lender's return instead of the buyer's ownership stake in the house. Right now, roughly 40% of owner-occupied homes in America already carry an unusually low mortgage rate. That means their rate sits under 5%, a full percentage point or more below what these two buyers just signed for. 15-year loans stay unusually unpopular anyway, because most borrowers chase the lower monthly number over the lower total cost. But almost nobody realistically keeps a mortgage for its entire full term, which changes this hidden cost picture completely. So the $453,000 interest figure almost never actually gets paid by anyone in full. The number that actually matters is much closer, much sooner, and about to look very different for both buyers. That closer, more honest number starts with how long people actually stay in the house they buy. Redfin's most recent data shows the typical American homeowner actually sells or moves after about 12 years. 12 years is now the longest median tenure since 2022 and considerably longer than it was 2 decades ago. So the fairest comparison isn't the full loan term at all, it's what each loan looks like at year 12. By year 12, the 15-year buyer has paid down roughly $255,000 of principal. The 30-year buyer, on that exact same timeline, has paid down only about $69,000 of principal. That's a gap of about $186,000 in built-up home equity after those same 12 years. On paper, the 15-year buyer looks like the clear winner the moment either of them decides to sell. This comparison leaves out home price appreciation entirely, since both buyers own the exact same house either way. But the 30-year buyer never actually spent that extra amount each month on the mortgage itself. Where did that money go instead? And what would it actually be worth if it went somewhere else entirely? The S&P 500 has averaged close to 10% a year since 1957, according to Fidelity's own long-run figures. Picture that 30-year buyer investing the monthly difference every single month instead of sending it to the bank. Run at that same historical average. The monthly difference between these two loans grows to roughly $199,000. That's within about $13,000 of the equity gap the 15-year buyer built by paying down faster. Two completely different strategies end up landing almost neck and neck after the exact same 12 years. That result is genuinely surprising, given how completely different these two loans feel on paper from month one. That near tie still skips one more real-world asymmetry, the tax bill waiting on only one side of it. Paying down a mortgage is never a taxable event, since reducing debt was never counted as income in the first place. Growth sitting inside a taxable brokerage account works differently, since the IRS taxes real investment gains once an investor actually sells. So, why does paying down the mortgage faster still feel like the obviously safer choice to most people? Home equity is guaranteed by the math on the loan documents. A market average is never guaranteed to anyone. That 10% figure is a long-run average built from decades of ups and downs in the market. So two strategies that look tied on average can feel very different once real risk enters the picture. Real risk enters this exact picture the moment the market actually behaves the way markets sometimes do. In 2008 alone, the S&P 500 dropped nearly 37% in a single brutal year of trading. Would you have kept investing that same monthly amount every month during a year that looked like that one? This is the real catch hiding underneath the entire comparison, and it has nothing to do with either interest rate. The invest the difference strategy only works if the difference actually gets invested every month, including the frightening ones. Most people who choose the lower payment do not consistently invest the leftover cash every single month. That extra money quietly gets absorbed into daily spending, a nicer vacation, or a slightly bigger car payment. The 15-year loan removes that decision from the buyer completely, whether they feel disciplined or not. The bank simply requires the higher payment every month, discipline or no discipline, good mood or bad mood. You do not get a choice about whether you feel like paying extra principal down this particular month. That forced structure is worth something real, even if a spreadsheet cannot fully price it as a return. There's also the rate lock-in effect shaping this decision, something 2020 and 2021 buyers already understand firsthand. Millions of those earlier buyers locked in rates near 3% and have barely touched their mortgage since. Anyone signing at today's 6% and above is accepting a genuinely more expensive decade than recent history offered. If rates fall meaningfully later, either buyer can refinance, though refinancing itself carries closing costs worth factoring in. Life events also do not check anyone's amortization schedule before showing up uninvited, a layoff, an illness, a move. A 30-year buyer facing one of those events can pause extra savings without missing the required payment. A 15-year buyer facing that same event has far less breathing room built into the monthly number. So does guaranteed discipline beat a probable but genuinely uncertain market average? The honest answer depends on the household. It depends on how this exact household actually behaves once the signing excitement of moving day wears off. Steelman the 15-year loan first, because its case is genuinely stronger than the earlier numbers might suggest. Its rate today sits at 5.93%, meaningfully lower than what buyers pay for the 30-year loan. That 30-year rate, 6.55%, is the higher one by comparison, and that gap compounds over time. A lower rate stacked on top of a shorter term means less total risk sitting on the household's books. The 15-year buyer also owns the home outright 15 years sooner, completely free of any mortgage payment. That freedom compounds too, since a paid-off house frees up cash flow for the rest of that person's life. Now, Steelman the 30-year loan, because dismissing it as simply the expensive option misses its real strength. That monthly gap between the two loans is genuine breathing room inside a July 2026 economy that feels tight. It can cover a job loss, a medical bill, or tuition without ever touching the equity locked inside the house. A 30-year buyer can send extra principal in a strong month and simply skip it in a lean one. A 15-year buyer locked into that higher required payment has far less room if income drops suddenly. Weighed fairly, both sides settle into a pattern that depends entirely on the household making the choice. If the household has stable income and genuine investing discipline, the 30-year plus investing the difference can match the 15-year. If the household values a guaranteed forced payoff over a probable but uncertain market average, the 15-year wins outright. For buyers within a decade or two of retirement, that forced deadline of a fully owned home tends to matter more. For younger buyers with decades of career ahead of them, The extra monthly breathing room often matters more instead. Buyers already carrying other high-interest debt should generally lean toward the payment that leaves more monthly cash free. Buyers with a stable job, an emergency fund, and real investing habits already have the harder part solved either way. Remember those two buyers who signed on the same July morning for the same $440,000 house? 12 years later, neither one turns out to be objectively wrong about the choice they made that morning. They simply bet on two different kinds of certainty, one built into a house, one built into a market. So, more than any single number in this video, which kind of certainty actually matters more to the household signing that paperwork? Which kind of certainty would you personally bet on, a paid-off house sooner or a market average over time? That same kind of hidden math shows up in plenty of other everyday money decisions most people never actually run. This video is for financial education only, not personalized financial or tax advice, so run your own numbers with a professional before signing anything.